joining us today for our special edition webinar where we're going to be looking at the coronavirus and some of the declines that we've seen in the oil market. We've split today's webinar into three separate components. Part one, we're going to be talking about the spread of the virus and the impact that we've seen in financial markets. Part two, we're going to provide a brief update on our model portfolio performance, positioning and recent decisions that we've been making in our models. And part three, and potentially the most important, we're going to be talking from an outlook perspective, the strategy that we've developed into the different baskets that we've decided and some of the stocks that we're going to include within them. So to begin with, I'm going to pass across to James, who's going to talk you through some of the virus spread, the impact on financial markets, and potentially what's been happening in oil.
Thank you, Simon. In rapid succession, the global economy this year has been subjected to two very severe shocks. The first is the coronavirus epidemic, which began in China. The second is the dramatic collapse in crude oil prices over the past week. When the coronavirus was first emerging in China, the markets viewed this as a potential supply shock. As a supply shock, it was something that I think most people thought could be easily recovered from in swift order. As the coronavirus has spread outside of China into Italy and beyond, I think markets became much more concerned. And that's where we see the decline in global equity markets coming to fore. The concern that the markets now have is less of a supply shock out of China with supply disruptions and thus a V-shaped recovery, and instead a demand shock which affects the global markets and potentially leads to a U-shaped global recessionary path. The third issue that I think markets are now very focused on is whether there's going to be a financial crisis, a systemic financial crisis, as the shock from the coronavirus is exacerbated by the hit to certain sectors in the energy space from the collapse in crude oil prices. So I'm going to spend the next few minutes talking about those three markets in particular, the bond market, the equity market, and the energy market, or the oil market, and how that is related to the investing landscape that we're currently seeing before us. There has been a substantial policy response to the impact of the coronavirus so far. It has not been a concerted policy response, but as the following two slides show, just about every central bank around the world, we have 16 at last count, has made an effort to cut rates or to ease monetary liquidity. The problem that we face is that as we were coming into this crisis, very, very few central banks had much room to cut. The only one with any real capacity was the US Federal Reserve. We saw a very swift 50 basis point rate cut last week. The markets have already priced in another 75 to 100 basis points over the next two meetings. That's a substantial easing, but that's probably about as far as the US Federal Reserve can go. The Bank of England gave us 50 basis points, but again, they're now pushing the zero rate bound, below which there just isn't going to be any capacity for further easing. A similar story with the Bank of Japan, a similar story with the ECB. So central banks are not going to be well positioned to provide any kind of meaningful liquidity support beyond what's already been done. On the fiscal side, there's a lot more scope for support. The worrying aspect here is actually with the United States, where the federal deficit at around 4% of GDP is already at a level that is typically seen during the depths of a recession. So if you think about government revenues and expenditures, tax revenues tend to decline when economic activity slows. Expenses, welfare, unemployment tends to increase. And so generally, we would expect a budget deficit of around 4%, more or less, to mark the low point of the federal budget cycle. Unfortunately, the US is coming into this crisis already at that level. So the capacity for the United States to add to stimulus measures that have already been announced in Japan, Korea, China, throughout Europe, the UK, is quite limited. And this is a concern. I am optimistic, however, that both central bankers and government policymakers are, for the most part, attentive and aware to the needs of the market in this current environment and are micro-targeting support, which is exactly what's needed. A generalized cut in interest rates and provision of liquidity is fine, but what you really need to do is to make sure that distressed names out there don't go under and default, potentially sparking a cascade of defaults throughout the market. And this is something that the ECB, the B of E, and the Federal Reserve have all been looking to do. In addition, there has been creative policy response coming out of Italy, for example, and the UK, in how to target fiscal support to those firms and individuals who would be most hit by the coronavirus crisis. So I am optimistic that there will be some policy tools that can be brought to bear, but I think we need to be cautious and careful in how much we expect governments to do for us. As Simon said, there have been a number of unprecedented market moves, and it's hard to almost wrap your mind around how dramatic some of the current market conditions have proven to be. In the United States, for example, the S&P 500 has seen its swiftest move into a bear market ever. I have data that goes back to 1870 on U.S. long bond yields, and the U.S. 10-year has fallen below 1% for the first time and continued on its way to 50 basis points, which is, again, simply unprecedented. Throughout the bond market, the signals that we're seeing are very recessionary. The bond market is telling us through the yield curve, through the long end of the bond curve, that a recession is increasingly likely. And one of the charts that I like to look at is the 10-year forward break-even rate. Now, this is basically the bond market's estimate of how inflation is expected to pan out over the next 10 years. And as you can see from the chart that I've shown you, the spread between the U.S. 10-year bond and the U.S. 10-year tips has come down sharply. And this really indicates only one of two things. One, that the bond market is expecting a dramatic slowdown in economic activity and a dramatic slowdown in inflationary pressures, or that the bond market is starting to break. This is what we saw in 2008, where the bond market actually started to break. Right now, I think it's indicative of a market that's pricing in a recession. But I think we need to be very careful and attentive to signals that might indicate that there's further systemic stress throughout the financial system. Some of the indicators that I look at, high yield spreads, the FRA-OIS spread, these are starting to flash amber lights. CDS, credit default swaps, for example, are at the highest level that we've seen since 2008, but have not gone beyond those early 2008 levels. So the financial markets are intact and are showing signs of concern, but not yet signs of fracture or collapse. The very difficult thing that we face at this point is trying to understand what the impact of these twin shocks might be on equity valuations. And the problem here is that we just don't know what's going to happen to earnings. The coronavirus in particular is an unprecedented sort of economic shock. It really has gone well beyond SARS in its impact on the global economy. So until we start to see earnings releases from major corporates helping to identify what kinds of impact they're starting to see through their order flow, and until we start to have economic data for the month of March that we can analyze, it's going to be very murky. What we do know is that in February, the Chinese government, in order to stop the spread of the virus, effectively shut the Chinese economy down. And in 1 month, we saw Chinese manufacturing PMIs plummet to the lowest level on record, lower even than 2008. And that was a very, very dramatic move. I don't expect we'll see anything remotely as severe outside of China, not least because efforts by other governments to quarantine and control have not been as, shall I say, harsh as the Chinese have taken. But I do expect that there's going to be a significant economic fallout globally, similar to what we saw in China. As a result, while it's impossible to say how deep and for how long the economic downdraft is going to last, the risks of a recession are extremely high at this point. And until we understand how that's going to flow through to companies, it's going to be very difficult to value the impact on the S&P or other equity markets. It is safe to say that if we have a bear market that's related to a recession in 2020, it will likely bear some resemblance to the two instances that we've had earlier this century, the 2001 recession and the 2008 recession. And in each of those cases, we saw the equity markets decline by around 50%, and we saw the price-earnings ratio, the forward price-earnings ratio, decline by anywhere from 4 to 9 points. So that would give us a rough and ready measure as to what we might be able to expect with this bear market, and that would suggest that we're somewhere between halfway and 2/3 of the way through the equity price correction. The second major economic shock which has struck the global economy over the course of the past 10 days has come out of the Saudi-Russian oil price war. And this is completely unrelated to, I think it's completely unrelated to coronavirus, and is quite dramatic and quite significant. The oil market was largely oversupplied as we came into this coronavirus crisis. So it was not a terribly tight market. When the coronavirus struck, transport-related oil demand took a great hit, and most analysts have ratcheted down their demand forecast for crude oil to zero growth for 2020, and that would be the slowest pace of growth since 2008. So that's already a very bearish oil market outlook, and as a result, crude oil had fallen by just over 30% before the Saudi announcement of over the past 10 days ago, a week ago, came out. As part of a response by OPEC Plus to the weakening oil fundamentals, the Saudis were arguing strongly for maintaining the existing cuts in OPEC production and adding to these cuts, so tightening the market even further. The Russians disagreed, and on Friday of last week, the OPEC Plus meeting ended acrimoniously. Over the weekend, the Saudis announced first that they were going to be introducing their official selling price markers for April at unprecedented discounts. So, for example, the chart that I'm showing you here is the price that the Saudis charge for delivery of crude oil into Europe, and this is where the Russian crude oil is generally sent. The Saudis have typically sold their oil to European customers at a discount of anywhere up to $4 a barrel versus Brent. The Saudis over the weekend announced that this discount would be raised to $8.10, which is twice the discount that the Saudis have ever offered. This is very clearly a move by the Saudis to take market share, and it's a move by the Saudis to take market share from the Russians. Over the weekend, the Saudis also announced that they were prepared to increase their production of crude oil from 9.7 million barrels per day to 12.3, which is a dramatic increase, and on its own will mean a severely oversupplied market. Now, what does this mean for our equity and bond markets that we focus on for our investors? Whilst the U.S. shale oil production is not the target of the Saudi-Russian oil price war, it is collateral damage. With oil prices plummeting below $30 a barrel, most U.S. shale crude is uneconomic. And it is highly likely that we are going to see financial distress in the U.S. shale patch. This is going to have, and it's already having, a dramatic impact on the high yield market. And there is concern that any wave of bankruptcies coming out of the shale patch in the U.S. could lead to further widespread financial distress and could contribute to the systemic risks that we've already touched upon. At the moment, the price looks like it's going to be under a lot of pressure for an extended period. We see little sign of a Saudi-Russian rapprochement in coming weeks and months, and as a result, we expect oil prices to remain under considerable pressure. This, as I've suggested, makes many shale oil producers uneconomic, pointing to worries for financial distress, which could leak into the high yield market and beyond. And this is an issue that we think is going to persist throughout 2020.
That's a good point. And in November last year, we started pulling out all of our US high yield from our model portfolios and started rotating that across to European high yield. And one of the primary reasons for that was energy exposure that we saw sitting within the index, which leads us neatly on to model portfolios. I think one of the key points that we need to make here is we obviously didn't have the foresight that the coronavirus was going to spread in the way that it did, because when we came into 2020, I don't think anybody other than a few select people in China had heard of it. So from our side, when we entered 2020, we were incredibly defensively positioned, but this was on the valuations perspective. So we thought that the PE ratio of the S&P 500, as one example, north of 19 was far too stretched, far too high, and we'd taken a lot of the equity exposure out of our client portfolios. With the models that we're running on an absolute return basis, the idea is that we're trying to protect our clients from the potential of those large drawdowns and maintain the real value of their portfolios. So when we saw what we believed was the sort of the top of a bubble in the S&P in essentially global equities, company earnings being stable, we were starting to see already expectations for 2020 withdrawing down. The 2021 earnings were not growing. So we thought that valuations were too stretched and the market needed some sort of correction. Ultimately, as it turned out, having started the year with some of the back and forth between Iran and the US, the initial news of the wildfires in Australia, it was the coronavirus that's become the catalyst that's caused the markets to pull back. From our perspective, our portfolios have been almost ideally positioned, coincidentally, because of the valuations. Now, that being said, that's meant that we've not had to reduce much risk on the equity side in our model portfolios. But by the 11th of February, so just over a month ago, we were already cautious about the spread of the virus and the impact that this could have on the supply side of the global economy, potentially on consumer behavior and therefore spending patterns. So for the last month, we've been working on our looking forward deployment strategy and what we think would make sense to both hold going forward, but we have also in the last couple of weeks been evaluating some of the positions that we currently hold in portfolios. So when we reached the end of February, we had already started liquidating any position related to the energy sector, mining sector. Most of that was fixed income related. When we entered March, we actually sold the European high yield position that we had rolled into in November last year. And a lot of this has been about protecting your money, protecting the models, protecting from some of the volatility that we have seen in the markets. a big part of what we're looking at is we're in the same position as a lot of other investors, a lot of CEOs from S&P 500 companies, that we don't know how bad the virus is going to get. What we do know is that we're very, very defensively positioned. Our models are holding equity exposure in the low single digits, and we have got our largest holdings in government bonds. What that has meant from a performance perspective, euros is much more difficult because of the already negative yielding rates, but for sterling and dollar portfolios for the conservative models, that's enabled us to achieve positive performance year to date, but also on a month to date basis. Because that equity allocation is so low, we have been able to mitigate entirely, and then because of the performance, we've already seen interest rate cuts coming in from, as James mentioned, 16 central banks. That's enabled us to not just protect, but to grow our clients' asset base over what has been a very, very volatile period. So from our perspective, it's been nice that we have had the exposure to equities being at incredibly low levels. We have already taken preventative action to try and ensure that we are as defensively positioned as possible in this current difficult environment. But our focus is increasingly switching to the idea of redeployment and how we can possibly look to redeploy and where. Just as a couple of different points that I wanted to raise on the energy default, as James was talking, we've seen yields and spreads shoot higher. We've seen some of even the European high yield, which has minimal exposure to equities, declined. Energy has declined north of 10% in the last 2 weeks since we sold it, which we're happy for. And what we're looking at now from a sell-off perspective is the fastest sell-off since Black Monday in 1987. This has been brutal at times. We saw the fastest 10% decline in the S&P 500, and we saw the biggest weekly loss in the FTSE 100 since 2008. Some of these have been unprecedented. Some of them are echoes of what we saw in 2008. The big thing that we are unsure of is how quickly and how far this is going to spread. In Europe, Italy is the most advanced in terms of quarantining the entire country. For us based in the UK, the question is going to be, are we going to end up in a similar situation? If so, how quickly? That has arguably a much smaller impact on the markets, and this is going to be focused more on what the US does, how many cases and what actions the government take from a quarantining perspective, because that's going to have a direct impact into the equity markets. So when we are looking forward, we're not looking at particular levels, we're not looking at stock prices, we're looking at the concept. We don't know how bad it could get. We acknowledge that there's a possibility that it could get significantly worse. What we've been focusing on and working on is making sure that we're in a position that we can pull the trigger and re-enter equity markets into both companies and sectors that we feel more comfortable with, that are going to be able to rally back and outperform broader indices going forward. Just in terms of, because many of you will know some of our individual holdings, we've been tracking the performance of our 3 single stocks that we continue to hold, or did until recently. EA, being one of our video games ideas, has held up incredibly strongly and is down just shy of 5% year to date. The worst performer of the 3 was Mail.ru, which, despite having very good fundamental results, was being sold primarily because it was a Russian denominated company. So we've trimmed Mail.ru from all of our client portfolios, so we're currently sitting with even less equity exposure than we had 2 weeks ago in both Tencent and EA. Now, moving on to part 3, where we're looking at the deployment strategy going forward. There's just a couple of things that I wanted to say before we get James and Max involved. Many of you will know that we're running a core satellite strategy, and the idea on the satellites, especially in the equities, is that we're looking at this idea of thematics. And when we're looking at thematics, the start point for thematics is and what do we as humans need. And this is something that, as a question, is starting to come back into the fore, because the the answer to what we as humans need is food, water, and shelter. Apparently, if you're in the UK, the fourth one is toilet paper. But at the moment, from where we stand, what we're looking at is, irrespective of whether you're in work, quarantined at home, whatever country you're in, you still need food, you still need water. Where you have the flexibility is how you buy those items, where you buy those items, how you buy those items. And this kind of gives you an idea in terms of what we've been looking at more from basket one. So basket one of the three is looking at companies that are more resilient to the coronavirus because they either have less direct exposure or in some way, shape or form there's going to be a benefit to them. Some of these companies are fitting very nicely into the thematic ideas that we've been exploring over the last 12 months. So when we're looking at digital life, video games, online life, emerging market consumers and the raising levels of disposable income, along with this idea of human staples, this is filtered into our basket one. So we're looking at companies where we have the ability to do e-commerce so that people can still buy online. They can receive food and groceries delivered to their home through some of the stocks. And one other important aspect, which not sitting in the what do we as humans need, but actually what do we as humans want, comes down to this idea of entertainment. When people are quarantined, if they're sitting at home, there is still a need for us to consume, whether it's literature, films, when we're getting some form of entertainment coming into the home. We've identified some particular stocks where we believe that there could be an interesting opportunity for the companies from a revenue perspective. Just to reiterate, when we're looking at these, we've selected the stocks, the sectors. You can see on the slide that they're coming from different countries around the world. We are not giving any entry prices, any entry valuations. We're having to look at this as a basket that we would buy as a basket. The decision from our perspective as an investment team is when to pull the trigger and to buy the basket. And that's going to depend on the actions that we see from government and how bad the virus spreads and what actions governments are having to take. At this point, I'm just going to pass across to Max and ask him to comment on one or two of the stocks that sit within the basket.
Thank you, Simon. So the first company that I would like to talk about is Ocado Group. Ocado is a UK-based online grocery company which has the leading technology with 20 years of experience in the online grocery segment. It operates grocery shops here in the UK as a joint venture with Marks & Spencer, which starts in September. But its main product is its technology. So the company offers a full solution in online grocery, including hardware for fulfillment centers, the software needed to operate the robots, and also full integration within the system. Within the current environment, we believe Ocado is a natural investment opportunity as people will tend to shop more via online channels rather than going physically into the stores. The company also has big opportunities internationally. Currently, it has partnerships in the US with Kroger, in Canada, Australia, and we believe there is more opportunity and more potential markets to open for the company. And the second company that we would like to talk about is JD.com. JD.com is based in China. It's an e-commerce player as well. And the key differentiator for JD is its own operated logistics system. So it has proven as a key asset during the coronavirus outbreak. And when the company reported its earnings a few days ago, what stands out is its outlook for Q1 for this year. So the company expects its revenue to increase by 10% year over year. And when you compare it with Alibaba, which expects its revenue to decline, you can see that its own operated logistics have proved as a valuable asset in these conditions. The company also earns a higher proportion relatively to other e-commerce players in China from fast-moving consumer goods, which are the necessities that people just have to buy. So we believe JD.com is also positioned attractively within the current environment. And now back to Simon for basket number 2.
Perfect. Thanks, Max. So basket number 1, the idea of companies being resilient to changing patterns of consumption behavior. Basket number 2, which we've called recovery, initially we kind of tentatively labeled it as the ugly ducklings basket internally. The idea here is that these are companies that have a lot of exposure to the fallout from coronavirus. So if you scan down the list, you'll see Walt Disney, which obviously had to close a lot of its parks around the world to try and prevent the spread. Companies focused on tourism, travel, so Delta Airlines is one example, Trip.com, which owns Booking.com. So we've kind of tried to identify companies where they're going to see significant declines in revenues over the next quarter, potentially 2. But at the same time, have strong enough balance sheets and cash positions to be able to weather the storm. And the idea here is they will be shunned by the market, substantially sold off by investors, therefore will be available at very attractive entry points from our perspective. Peugeot is one interesting example here that I'll highlight before I pass over to Max. Peugeot was a company that we owned last year in our models. We held it for a small number of months, and it formed part of our European defensives theme. The stock rallied 10%, and we exited it because from a valuation perspective, we didn't feel that we could continue to call it a defensives idea. It's declined somewhere between 40 and 50% since we exited it last year. We've been tracking it for the last 3 to 4 months, trying to find better re-entry points. We still believe at current prices that we could get better entry points for Peugeot. So this is another one that we're going to continue to own, and at the same time as basket 1, when we think that we've hit some sort of bottom, then we will look to go in across the basket and to try and take exposure. These would be potentially shorter holding stocks as opposed to basket 1, where there's a good fundamental reason for changing on a consumer pattern behavior perspective, whereas these are going to be more of a recovery play. So I'll just pass across to Max to talk through some of them.
Thank you, Simon. As you just mentioned, Walt Disney is one of the companies that sits within this basket. And if you think about it, the company will have impact from the coronavirus in its parks and studios segment as people sit at home instead of going outside. This will bring some damage to revenues. However, Walt Disney is one of the oldest companies in the world, and its wide portfolio of unique brands should position the company attractively longer term. And another aspect that I would like to highlight is that the company recently started its efforts in the streaming industry. So it has launched its own Disney Plus service. So far it has been successful. There are almost 30 million subscribers already. Later this month, service is launching here in the UK. And given brands that Disney have, we think this is a strong long-term driver for the company. And also when the coronavirus will be over around the world, when parks will reopen, we believe that people will go back and spend money on both parks and movies. So we see Disney is a natural play for the recovery. And also, what I would like to mention as a last point is the company has recently changed its CEO, and the new CEO mentioned that his long-term strategy is to increase the presence of Disney brands in those parts of the world where currently it is not present. And company number 2 is Delta Airlines. Delta is one of the major legacy airlines in the US, and airlines are definitely the sector that will be impacted by the coronavirus. It has been already impacted, and we will see more concrete numbers when the company start to report their earnings, especially given the recent news that US now put on hold all passenger travels from Europe, from continental Europe. But Delta is, we believe, should recover from the coronavirus. It has a very strong balance sheet. It has a very capable management team, and the demand for airlines after the whole coronavirus outbreak is over should recover, which will then naturally drive the performance of Delta Airlines. So now back to Simon for basket number 3.
Perfect. Thanks, Max. And just to make the comment that although we've selected these stocks as what we believe to be the best way to play this ugly ducklings basket, we're constantly monitoring the markets, looking for new opportunities, and we may end up substituting some of these names depending on the performance and the length of time before we hit some sort of bottom. Our third basket is focused on energy stocks. You've already heard James talking a little bit about some of the movements that we've seen in the energy market. So I'm just going to ask James to talk through a little bit about the concept behind it, and then to pick out a couple of the companies as well.
Thank you, Simon. So as I was describing before, the Russian-Saudi oil price war that we're currently witnessing has a dramatic impact on the U.S. shale oil producers. I don't think that the shale oil producers are the target of the Saudis, but there's no way that they can avoid being swept up in the collapse in oil prices. So one of the results is that we expect a severe financial distress throughout the U.S. oil patch, particularly amongst the more leveraged high-yield names. Nonetheless, when the dust settles, we will still have oil companies. And the question then becomes, at that point, which ones? One of our preferred picks out of the integrated E&P space is British Petroleum. They've made a lot of progress with decarbonization and with diversifying into natural gas and renewables. And this, I think, has given them some claim to ESG credibility, which I think in the energy space is a particularly rare and valuable commodity to have. So that makes BP fairly attractive. They've made substantial efforts over the past few years in improving their break-evens, which are projected to reach $43 a barrel by 2022, which puts them well ahead of most of their industry peer group. So on a cost per barrel basis, they look pretty good. They have an extensive amount of downstream capacity as well, so that diversifies their exposure. They're not simply an oil extraction company. They're also involved in refining, which I think will help to balance them during an extended period of low oil prices. So if you add it all together, they're pretty well positioned to survive a period of low oil prices and will be relatively attractive as we come out. So if we can see BP getting pushed down even further from current valuations, that will make them a relatively attractive play for an oil price recovery. The second company that we were looking at that we think has some advantage, and this might come as a surprise, is in the natural gas space. So EQT is the largest natural gas producer and distributor in the United States, and they've just recently completed a demerger with their internal pipeline provider. So what this means is that EQT is now very much a pure play on natural gas. They are holding assets in the Marcellus Shale region, which are at the lower end of the cost curve, so they're fairly attractive. Over the past 5 years, the shale oil boom in the United States has created an enormous surplus in natural gas. Natural gas is being pulled out of the ground as a byproduct of shale oil production. That's placed natural gas producers under an enormous amount of pressure, and EQT was not spared. So their current valuations are extremely attractive if we believe, as we do, that with a slowdown in shale oil production, we'll also see the halt in this excess natural gas that's been such an overhang on the market. Right now, EQT is pricing under what we would estimate their NAV to be. So ideally, that should be supportive to the downside. And we think that their recent work in restructuring and improving their own operations has made them more nimble from a capital perspective and better placed from a free cash flow perspective. So those are two energy names that we want to keep an eye on as having potential value should the end come in sight for this current oil price conflict.
Thank you. And for those of you that have UK-only portfolios managed by Dolfin, BP was one of the stocks that we sold as we entered March, slightly concerned about the oil price declines that we were seeing even before we had the OPEC Plus meeting. So it may well be that we end up rebuying that at a substantially lower price. Anyway, thank you to everybody for joining this afternoon. Just a few key takeaways from us. Number one is going to be continue to remain defensively positioned in your portfolio until something changes. What that something is, we're all waiting to find out. Number two, when you do go back in, there's going to be some highly differentiated performance numbers coming between companies, sectors, and potentially even countries. So from our perspective, it's about being incredibly careful about not just when you go back in, but also where you go back in, and whether you do that through broad-based ETFs, funds, single stocks, futures, whatever way you choose to take the risk exposure into portfolios, you have to be incredibly careful about how this is going to be incorporated. And number three, at some point, this will pass. One of the ideas between running the MVST strategy in our portfolios is we're trying to look at multiple different factors with different timelines and time horizons. And the S for sentiment, which we're using as a contrarian indicator. The idea here is potentially the best time to buy is when everybody's scared and running away and selling. And that's when we need to stay strong, look forward and enter into what potentially could be one of the best buying opportunities that we could have in the next 10 years. If there are any questions, please reach out to your Dolfin relationship manager who can pass them on to us, and we'll try and get back to you as soon as possible. Otherwise, thank you very much for joining this afternoon.